You had mentioned a second type other than the cash trust.
Yeah. So the other solution for someone who has a portfolio or someone who has a wide range of assets other than just cash and near cash assets, then they may choose to form what we call a family trust or a living trust or a private trust. It's one and the same. They all mean one and the same thing. So this is where now you define specifically how you want your portfolio of assets managed for the benefit of the beneficiary. So this is more comprehensive because you'll be talking about your current beneficiary. You'll be also talking about generation beneficiary. So it doesn't only take care of just the first generation beneficiary.
Can be your children's children.
Yeah, it can run on and on and on. Yeah. So because now this is very specific to you, you're able to create the rules that guides its operation. So you can go to the specific details on how you want the specific asset to be managed. Then the aim is to ensure that it flows or it consolidates the assets. So the assets are able to flow from one generation to the other.
Yes.
It doesn't only seeks to distribute.
Yes.
It seeks to consolidate and have them managed as an item for the benefit of the beneficiary, current beneficiary, and future generation.
Yeah.
So this one you create the same way you create a limited company. I usually like comparing it with a limited company with the small variations that you are giving instructions on how you want your estate to be managed or your assets to be managed. You are saying who do you want them to manage. That is the trustee.
Yes.
Of course, in your lifetime, you can be the trustee.
Yes.
Then you are saying who benefit from whatever is in the trust. So it's a more comprehensive and able to take care of all the assets that are out there.
Hello and welcome back to the Synod Podcast, the platform where we take a no-frills look at the insurance industry in Kenya. I'm your host, Elisha Kidenda, and in studio with me is someone who I consider a mentor and a friend in this industry, a veteran of this industry, Mr. Nahashon Mwiruri, and is here to speak to us today about estate planning, wills, trusts, and all that goes with estate planning. Welcome, Nahashon.
Thank you, Elisha, for having me today. Pleasure to join you and expound on this topic on estate planning. We see what we can do to help our clients and even the society plan better for their families.
Thank you. This is a question that I keep getting asked a lot about estate planning, trusts, and wills, especially when I'm speaking about life insurance.
Yeah,
people have concerns about who is going to manage the payout when their sum assured comes due.
Yeah,
and they would like it to be managed by a competent person.
Yeah,
or ensure that how they envision those proceeds to be spent is exactly how it happens.
Yeah.
So for the purposes of today's episode, I just come up with a list of questions which will hopefully illuminate this subject for us and help both myself and whoever is watching understand this space better.
Yeah.
So I've just divided it into 3 sections where we just get an understanding of estate planning, then we demystify the trusts, and then if you have any practical tips on myths and real life scenarios that we can look at.
Okay, that's good. Yeah.
So the first question, when we are talking about understanding estate planning, what exactly is estate planning and why is it important for every adult, regardless of wealth?
Yeah. Yeah, most of the time you find when you talk about estate planning, people think it's a very complicated subject, but indeed it's not. Yeah. So in very simple terms, what estate planning is a process. One is not a one event; it's a process where one determines on how whatever they have accumulated over time is going to be administered in an orderly manner in their lifetime, and in the event that they are not there or they are not in a position to manage those assets. So there are two key things that I would like someone to note, that you're talking about not just administration but order. Yeah, you're talking about a lifetime, and in the event that one is not there or in the event that they are not in a position to. So that process where one now put all those things into consideration and create a plan, that's what is called estate planning. Yeah.
Okay, so what I'm getting from that response is that estate planning occurs even before one passes away. It is something that you can use even in your lifetime as you are still functioning on this earth.
Yeah, that's correct. You don't have to wait for someone to pass on to start planning. Yeah. So you can always continuously build and plan for what is going to happen. Sometimes we do estate planning unknowingly. So, but what we need to do is to be a bit deliberate in doing the estate planning. So there are things that we do that are indeed estate planning, but back of our mind, we don't know that you're doing estate planning. Yeah.
Can you maybe give some examples?
Yeah, a good example of estate planning that we do is even before modernization, your grandfather or your great-grandfather, when they sat down and said, this piece of land will be divided into 4 pieces depending on the beneficiary. Yeah, they were creating an estate plan, even though unknowingly. They were just saying, how do they want whatever they have to be divided among the siblings who are there? So that's part of estate planning.
Okay, so when people hear estate and estate planning, what they are imagining, or at least what used to come to my mind, was someone who has property where you can actually call it an estate, like the estates that we live in. But maybe you can clarify for us what kind of assets can be included in an estate plan, and are there common ones people forget to include?
Yeah. So most of the time, the perception I get when I interact with a lot of people is when they hear estate planning, the first thing that links to their mind is real estate, which is not the same as estate planning. So they associate so much estate planning to those people who have physical titles and such. But indeed, when you talk about estate planning, you have to talk about each and every asset that you own, whether is real estate, whether they are financial investments that you have done, whether they are businesses, anything that you can say that as an individual or as a family you own. That's what constitutes your estate. Yeah. So you don't have to have so much for you to say you're doing estate planning.
Actually, that's one of the myths. People believe that estate planning is for the wealthy. Why do you think that is? And maybe you can clarify for that.
Maybe it's because of the way we have been socialized and what we see out there, or what is being projected out there. But now our goal as people in the industry is to try to enlighten various people that are out there, that you don't have to have wait until you have a lot of assets for you to start planning for them on how they're going to transition. You start as early as the time you take a policy of 5,000 that you're paying monthly. The moment you take that, it means that you're planning ahead. So, and as you plan ahead, you need to ensure that you put in structure, or you put in means in which the 5,000 you have been saving every month is going to be directed to the right purpose and for the rightful beneficiary. So you don't have to have a lot of assets for you to start doing estate planning.
Okay, what are the tools? What are the various tools that people can use to do estate planning?
There are various tools that one can use to do estate planning, but the main ones and the ones that are widely known is when someone is doing a will. That is one of the tools of estate planning, and the other one, which is now coming up strongly, is a trust. So those are the two main tools that I would say one can use to plan their estate.
What is the difference between a will and a trust? And do they work together or separately?
The answer to that is that they do work together. They work hand in hand. Will is the one that majority of the population would tell you they know about. Yeah, and it's because of our interaction. So because every now and then when someone passes on, you always hear people asking, did they leave a will or not? Yeah, and because you also experience it firsthand. If you have had a loved one who passed on and you try to do the process, they always ask you, did they have a will or did they not have? Yeah, so that's why will is more common or widely known. But by definition, a will is a list of wishes or of how you want your estate or your assets to be distributed in the event that you pass on. Yeah, in the event that you are not there. Yeah, so most of the time you'll hear confusion that the will need to meet maybe specific criteria. Yeah, but by definition, saying is a list of wishes. This is how I want everything to be done upon my demise. So there's an element that yes, you do the will in your lifetime, but you cannot implement it in your lifetime. So someone else is going to implement that will. So you have to wait until someone has passed on for you to implement that will. But in very simple terms, is a list of wishes that are duly witnessed as required. Two witnesses that are for a will to be valid, and it's only implemented upon the demise of the person who has made that will.
And those witnesses, is one of them the lawyer, or on top of that, the lawyer has to?
No, it doesn't necessarily have to be a lawyer to witness. Okay. One can make a will and have just two witnesses. So as long as they meet the criteria, they must be adults. They must be adult witnesses. You can't have a minor witnessing. So any person who is of majority age can be a witness that indeed I saw so and so signing this will, and they did it through without coercion. And they did it willingly. They were not forced to do it. So there are all those things that are going to be looked at to consider whether the will be valid or not. So, but you don't have to concentrate on so much on those details, but just know that it's a list of wishes that are duly witnessed, made in someone's lifetime, but implemented upon their demise.
How contestable are wills and trusts?
Now, let's start with the will, because that's what most people know. A will is a list of wishes where I've said how I want everything to be distributed upon my demise. Yeah. Now, this will is not, I would say, it's not a final document, and the reason for that is because it has to go through another process for it to be validated. And that process is a court process. Yes, I have made my wishes, but the will need to go through a court where now the will tries to determine who is indeed the rightful beneficiary of the estate of the person who has passed on. Now, that's where the biggest challenge lies. That, yes, I have made my wishes known. I have written them down. I have witnesses. But still, there can be someone who can come and lay claim to the estate.
Yes.
Yeah. So that's why now you hear contestation. Yes, I have made my wishes, but someone else has come and said, oh, you know what? I was also entitled to the estate. Now, the court has to listen to the person who is laying the claim and determine whether they have a valid claim or not. Yeah. So the challenge with that is that it takes time. It's not something that you can say it will be done within 6 months or within 1 year. You have no predictability of how long that process is going to take. Yes, will tools of estate planning is a tool of estate planning, but it does have its own challenges, and especially that process of validating that will. It may take a year, 2 years. It may take 10 years. You have others that have taken more than 20 years to implement.
Okay, so a will is contestable and has to go through a legal process to be executed.
Yes, so that process of executing is where now someone need to go through a court process and try to, because what happens is that when someone passes on, they cannot own assets.
Yes.
Yeah. So that process of going to court is to try to find out who is the new legal owner of this asset that have been left behind.
Yes.
So, and the validation is important to ensure that not everyone is included. So if you are given a chance, one can claim can lay a claim to any asset that is out there.
Yes.
So that court process is important just to validate who indeed is a owner, is a new owner. Who is the rightful beneficiary. So unfortunately, now that process you don't have control of the time that is going to take, and you don't have control of how much it is going to cost to do that.
Okay. Well, then what is the case then in trusts? Do trusts have the same limitations?
Yeah. Now, getting into the trust,
but maybe we are jumping the gun again. Maybe you can break it down.
Yeah.
What is a trust and how does it work in practice?
Yeah. So the trust is another important tool of estate planning, and a trust generally is a legal arrangement where one party give another the legal right to an asset for purposes that they are going to manage that asset, not for their own benefit, but for the benefit of specified beneficiary. Yeah. So the key thing is a legal arrangement.
Yeah.
But if you are to come back and try to relate to everyday life, I have this microphone today. I intend this microphone to benefit my child. But since I may be traveling for a long period of time, I give Elisha this microphone and tell him, kindly hold this microphone and wait until my beneficiary reach a particular age. You can hand over the microphone to him or her. Yeah. So in that case, I have created a trust arrangement with Elisha.
Yes.
Even though it's informal, it's not. It may not be considered illegal because we haven't. It has not been formalized. So we have created a trust arrangement, but it has no legal backing because it is dependent on. I know Elisha. He's likely to do what we have agreed. Yeah. So a trust is such kind of an arrangement, but now backed by a legal document.
Yes.
So there's Elisha who is giving the instructions on how they want the asset to be managed. But Elisha is meant to manage that asset not for their own benefit, but for the benefit of a specified beneficiary.
Yes.
Yeah.
So one of the concerns people have when you speak about trust is the trustees and who is going to who you're going to leave in charge of that trust in the event of your untimely demise.
Yeah.
Maybe you can speak a little bit about that. People want to have people who they can trust, but you're really not sure how far you can trust someone.
Yeah.
Are there professional bodies or institutions that can give you some peace of mind with regard to that?
Yeah. Maybe before I get to that, so that trust arrangement, you have said it's a legal arrangement. It has parties to it. And the parties to it, they are mainly three. You'll have the person who is setting it up.
Yes.
So who is the original owner of the asset?
Yes.
That is me and you.
Yes.
So you have the asset, but you want to create a framework that this asset is going to be managed in your lifetime, and in the event that you're not there, for the benefit of the specified beneficiary.
Yes.
So right now you are the owner of the asset, but you're creating a framework.
Yeah.
So that's the person we call the founder, or the person who is setting it up.
Now, then there's a person who will be given the mandate to manage it, either in your lifetime or in the event that you're not there. That's the person now you're calling the trustee, the one that you're asking about. Then now the final is a beneficiary. Yes, I have this asset. I'm creating a framework in which the asset is going to be managed in my lifetime and in the event that I'm not there. But who is going to benefit from that asset? That's the beneficiary. So those three, in a trust arrangement, they go hand in hand. Now, on the choice who manages the asset, that is a trustee, there are various ways to do it. Yeah. So today, as nation, I may choose that I trust Elisha that I can give them the mandate to be the trustee of my trust. Yeah. On the other hand, I may feel, yes, I trust him, but not 100%. Then I need to give Elisha and another friend of mine that mandate.
Yes.
So they work hand in hand. Yeah. To some extension, I feel, yes, based on my life experiences, I don't trust anyone 100%.
Yes.
Yeah. Then I will say, let me say Elisha and another company can run my trust, especially in my absence.
Yes.
They can work in hand to run the trust. So there are all those options. And the options that one select depends on their individual family circumstances, because families are unique in their own ways. So you wouldn't say that what works for me is the same that work for you. So you just choose what actually work for you based on the family history, the concerns that you may have, the assets portfolio that you are looking to be managed. All those factors will put into consideration before you select who is the rightful trustee that you are going to entrust.
Yeah.
So the other element that I may need to clarify that most people again forget or confuse is that they think that when you create a trust, you are giving that asset to the trustee. The fact of the matter is that not the case. The trustee is just there to act on behalf of the trust. There's a trust and there's a trustee. They are two different.
Yes.
So the trust is an entity that you have created.
Yes.
The same way you create a limited company. Yeah. So whether a particular trustee is there or not doesn't affect the running of the trust, because there will be mechanism in which the trustee can be replaced at any given time, either by virtue of them passing on, by virtue of them feeling that they are not ready to continue with the obligation. So all those things will come into play when managing the trust, and there are mechanism that ensures that the interest of the beneficiary are protected within the trust. And that's why it's very key to mention it's a legal arrangement. Meaning that when you say it's a legal arrangement, it means it has a legal backing.
Okay.
Yeah.
I've heard you mention a few times that you can establish the trust and it operate while you are still alive before your demise.
Yeah.
Why is that a smart move for someone to take? And what are the benefits of establishing it early and having your assets held in that trust early?
Yeah. So that will take me back to the definition of estate planning. The definition of estate planning is how you decide on how you want your assets to be managed in an orderly manner, in a predictable manner, in your lifetime, and in the event that you are not there, or in the event that you are not in a position to. Because sometimes you don't have the necessary to have passed away for you to require some assistance in the management of the estate or the assets. Yeah. So there is a key element of lifetime and in the event that one has passed on. Yeah. So when you talk about creating a trust in your lifetime, meaning that you are creating a structure that you're going to mature, a trust that you're going to mature in your lifetime, ensuring that you are not waiting until the tail ends of your life. That's when you are thinking, hey, what do I do with these assets, or what will happen to these assets? So what you call a living trust is a trust that you create in your lifetime. You can choose to manage it in your lifetime. Yeah. Build structure around it, strengthen it in your lifetime. Yeah. So that you are not creating a trust at the tail end of your life, then you haven't really experienced how the trust is running.
The operationality.
Yeah. So when you create a trust in your lifetime, it means that you're going to pick a few items here and there that may not work, because again, life is very dynamic. Today, I may have a brother, sister who I trust 100%.
Yes.
Tomorrow, they may not be there, or again, circumstances may have changed.
Yes.
Yeah. Today, I'm married with one wife. Tomorrow, married with several of them. So it's when you create a trust, a living trust, you're able to continuously improve, continuously amend to suit your current circumstances, rather than someone who decide to create a living trust when they are almost at the tail end of their life.
Yeah, that makes sense. That makes sense. So, what are the types of trusts that are commonly used in Kenya?
Yeah, that's a good question. Now, I would say there are two main ones that I would say increasingly people are taking. One, you as Elisha, because we said when we started, we said that you don't have to have a lot of assets to start your estate plan. Yeah. So what that means is that what happens to that person who just have a few insurance policy here and there, endowment policy here and there, whole life here and there. They have their money market. They have small assets. They are not as wealthy as people may want. So what happened to that person who, yes, they want to create a structure, but they don't have so many assets, and they need to start somewhere. So there is a simple trust that one can create. Normally, you call it a simple trust or cash trust. And the reason why it's referred as a cash trust is because of the type of asset that it manages. It only manages cash and any anticipated cash. Yeah. Because practically, you have taken an insurance policy, either education policy, endowment policy, you have taken a whole life. But have you ever asked yourself what would happen in the event that you are not there, and the risk that you have insured has materialized? So who do you nominate as a guardian? So usually you see your sister, your spouse, your brother. But how sure are you that contingent beneficiary, if they receive the lump sum that is payable, that indeed they are going to use it for what you intended it to?
That's a very real concern that I hear about all the time.
So that's a concern. Because I may have taken an education policy. The sole aim was to ensure that in the event that I'm not there, my child or my children go through school. But the moment an individual receives a 10 million lump sum and they haven't managed 200,000 at any given time in lump sum,
to wonder.
So you find that they now start having the best investment idea out there. They may have the best interest of the miners out there, but they now
lack the capacity.
They lack the capacity. That's the correct word to use. So the cash trust tries to find a solution for that. That today I can create a simple trust or a cash trust that will manage my benefits in the event that I'm not there. So I'm being proactive, creating a structure now. So the simple trust only manages cash. So there's money that you're going to put initially when you start. Then you tie in all the policies that you have taken out there to the trust. Yeah. Meaning, okay.
So the in the event of anything happen to you, all those cash or cash-like assets go in there.
Yes.
Then how do your beneficiaries now access it? How is it managed?
Yeah. So when we're defining the trust, we said a trust have to have a beneficiaries. So when you're setting up the simple trust or the cash trust as a solution, you'll say my intention for this trust or the purpose is to educate my children.
Yes.
Yeah. Then you go ahead and say, who are these children?
Yes.
It's child A, child B. Yeah. Now, then you go ahead and say that this child A and B, they are still minor.
Yes.
They cannot act.
Yes.
Then this is a guardian. In the event that I'm not there, this is a guardian. You can have 1, 2, 3, whichever number that you select as a guardian.
Yes.
Yeah. So now, in the event that you're not there and money comes into that cash trust, you have already, the cash trust has already the back-end information that this is a beneficiary and this is how they are going to benefit. Yeah. So meaning that now the trustee who is managing that trust is going to now act on your instruction.
Yes.
Did you say it's for education?
Yes.
Then child A need to go to school.
Yes.
This is a fee structure.
Yes.
The trustee pays school directly to fees directly to the school.
Yes.
Child B is going to school. This is a fee structure. Again, money is paid to the school. So this just ensures that whatever objective that you had, whether you are here or not, it's going to be achieved.
Okay.
Money is not diverted to all other type of or uses. Money strictly go to the rightful beneficiary and for the right purpose.
Okay.
Yeah.
Well,
that's now the simple trust, and which just to add, anyone can create.
Yes.
Yeah. The providers that we have out there on the trust, some require as low as 5,000 to start.
Okay.
So meaning that anyone who has done an investment out there, either in form of insurance, in form of money market or any other, then they can get the 5,000 to start off, and then
are there maintenance fees after you pay that?
Okay, most of the providers they will have what to call management fee. And management fee, essentially, what it means is that because the asset is there, 5,000 is there, or even $1 million, or whichever amount that is there, then the trustee need to manage these funds. And by managing means that what they are doing is that they are investing. Additionally, they are doing disbursements. So if the school fees need to be paid, they are doing disbursements. They are trying to look at the vehicles that they can invest in to ensure that there is a return. At the same time as they manage the disbursements to the beneficiary. So there will be a management fee, which is minimal because this money is earning interest at the same time. So so
that's important.
Yeah. The management fee will be minimal and manageable.
So you mentioned that these funds are invested, and like with any investment, investments can go up, they can go down.
Yeah.
Is there a minimum guarantee, or is it possible to have your funds in a trust and the funds are eaten up by bad investments?
I would say that's unlikely, and especially if you use a reputable provider, those who are providing the trustee services. So it's unlikely because the consideration, the biggest consideration, is usually to ensure that capital is preserved.
Yes.
Yeah. At the same time, they wouldn't want to put in money just lying in the bank without any kind of a return. So I haven't had an instance where money has been lost in a trust fund. So usually when they are doing the investment, they check on the liquidity. What is the liquidity of the fund?
Yes.
Because every now and then you'll have requests for disbursements.
Yes.
So you must ensure that liquidity is well taken care of, and the risk that is there that is taken again with the investment vehicle, it need to be manageable.
We will come back to how the management and the restrictions on disbursement when we go look at real world application and meets. You had mentioned a second type other than the cash trust.
So the other solution for someone who has a portfolio or someone who has a wide range of assets other than just cash and near cash assets, then they may choose to form what we call a family trust or a living trust or a private trust. It's one and the same. They all mean one and the same thing. So this is where now you define specifically how you want your portfolio of assets managed for the benefit of the beneficiary. So this is more comprehensive because you'll be talking about your current beneficiary. You'll be also talking about generation beneficiary. So it doesn't only take care of just the first generation beneficiary.
Can be your children's children.
It can run on and on and on. So because now this is very specific to you, you're able to create the rules that guides its operation. So you can go to the specific details on how you want the specific asset to be managed. The idea for this, the living trust, one is that you create it in your lifetime. So you are able to manage the trust in your lifetime. So that there are no surprises later on. So at least you have walked the journey. So even when you're leaving it to someone else to manage, at least it has matured. Then you can always modify as you go. So you based on the life changes or there's any material change in your life, you can always make changes to make it accommodate those changes. So as you go, you are maturing it. Then the aim is to ensure that it flows or it consolidate the assets. So the assets are able to flow from one generation to the other. It doesn't only seeks to distribute. It seeks to consolidate and have them managed as an item for the benefit of the beneficiary, current beneficiary, and future generation. So this one you create the same way you create a limited company. I usually like comparing it to the limited company with the small variations that you are giving instructions on how you want your estate to be managed or your assets to be managed. You are saying who do you want them to manage. That is the trustee. Of course, in your lifetime, you can be the trustee. Then you are saying who benefit from whatever is in the trust. So it's a more comprehensive and able to take care of all the assets that are out there.
Are trustees, the position of trustee contestable? Does trust go through probate or anything like that?
Now, this is something that you are creating in your lifetime. So as a founder, you are the one who decide who is a trustee, who is a beneficiary. And in the event the first trustee is not there, you are the one who decide who qualifies to be the successor trustee. So these are instructions that you have given on how you want everything to be run. On whether it is something that can be contested, of course, people can try to go to court, but most of the time, the chances of success are minimal because the instructions are very clear. As long as you haven't excluded a particular beneficiary by malice, or someone who was entitled to benefit, you have excluded them completely. Then you are unlikely to succeed even if you are to go through a court process. So it's a more structured way. And the other thing is it doesn't go through probate. That's something that you had asked. So if today I have created a trust and tomorrow I'm not there, the structure is already there on how I wanted everything done. So it will pick up immediately. as opposed to the other side where one need to go through a court process and all that, try to establish who is the new owner. The new owner in a trust setup or in a family trust setup is already known that it is the trust, not an individual.
Yes.
It is the trust.
Yes.
So the moment the founder is not there for some reason, or maybe they are incapacitated,
Yes.
then the trust is able to pick up itself, and the trustees now, they are the parties that manages the day-to-day operation of the trust. Okay. So there will be no gap. Everything will flow smoothly.
Okay.
Yeah.
What is the establishment cost of a family trust or a living trust? Or typically the range?
So it's usually depending on the provider. So the same way you'll have a supermarket selling one item at a particular price, another one selling at a lower price.
Yes.
So it usually it has a range. So you may find someone charging 250,000, 200,000. And you may also find someone charging $1 million plus to do a trust.
Does the complexity or the number of your assets matter?
Okay, to some providers it matters. To some it doesn't matter. Yeah, so it is treated I would say it is treated on a case-to-case basis. But the range, if you on average 300,000 to 400,000, you may have a living trust ready and operational. Okay. But that cost is also subject to who the provider you have chosen, and again you need to choose a provider who is competent in that line. Yes. So it's let me call it a variable cost, depending on the scope, depending on what exactly you want to achieve. Yes. You just need to engage the right provider for that service.
Okay.
Yeah.
What about tax? Are there any tax benefits of establishing a trust?
Yeah. Okay. I wouldn't want to call them I avoid calling them tax benefits, but they are tax incentives that the government has given.
Yes.
And the reason for that is just to encourage the population to plan their succession better.
Yes.
Yeah. So to avoid situation whereby you do have a number of court cases that relate to succession. So a family trust is the one that can assist in reducing those cases. And that's why the government saw it fit to put in some tax incentives.
Yes.
And one of it is when you're moving the asset, and especially property, from yourself, from your name to the name of the trust that you have created, a family trust that you have created, there is no stamp duty payable.
Okay.
Yeah. For someone who doesn't understand what stamp duty is, if you have done any land transaction, you are buying or you are selling, usually there's a duty that you pay to the government.
Yes.
Based on the asset value.
Yes.
So that is what the government has waived as a tax incentive. Then the other thing that the government has waived as an incentive to encourage the population to do succession better is capital gain tax.
Okay.
So there is no capital gain tax when you're moving the asset from your name, or you are donating the asset to the trust.
Yes.
So and capital gain tax again, this is a fee that you pay, or a tax that you pay to the government for asset appreciation.
Yes.
So maybe you bought a property at 5 million, then now you are selling it at 20 million.
Yes.
They will come and assess what is the capital gain tax. It's a percentage of the gain. So that's something that the government has given as incentive.
Okay.
Yeah. So then the other thing is,
what about if you want to buy a property? Can the trust buy a property directly?
Yeah, it can. The trust is a legal. The family trust will be a legal entity.
Yes.
And when you say it's a legal entity, it has the capacity to own and to transact.
Yes.
So meaning that if it decide to sell, it can sell.
Yes.
Of course, following the process.
Yes.
If it decide to buy, it can still buy. But now the buying, it may not be exempt, because it may not be exempt from the other taxes when buying.
Okay.
Yeah.
Okay. Understood. Okay. I think you've given us quite a robust explanation of trusts and how they operate, maybe we can go into real world applications now and some of the myths that may be out there. So we had said we'd come back to this, the beneficiaries. How do they typically access funds from the trust, and what kind of oversight or approval is involved?
Now, that again, you look at it in two folds. And that is, do you have a simple trust or do you have a family trust? Now, starting with a simple trust or the cash trust, at the point of setup, you say who is the beneficiary. And you say, if they are minors, you say who is a guardian. And again, at the point of setup, you say what is the purpose. Those are things that you define at the point of setup. In your lifetime, you can amend them as circumstances change. Yeah? Now, at the point now of accessing the benefits, they must be within the purpose that you define. Of course, as a founder, you can amend. But the other people who come after you, in the event that you're not there, then they cannot come to amend. So now, accessing the benefit, you just need to give instructions to the trustee, who is also the administrator. You give the instruction. So is there school fees to be paid for a particular beneficiary? Then you give the instruction attaching the relevant document. And in this case, if it's school fees, then it will be fee structure. Then the trustee wire the money directly to the school. So this just minimizes the interaction of cash with the guardian. So the guardian is there, yes, but they're not getting any cash.
They cannot withdraw money.
No, unless you give them the mandate to be getting upkeep. If you did not, you say the school fees, then for them, the guardian is just giving instruction to the trustee, kindly pay school fees for this beneficiary. This is a fee structure. This is the account number for the school. Money goes directly to the school.
Kindly clarify that distinction between the guardian and the trustee.
Yeah. So now, in a cash trust or in a cash management trust or a simple trust, the trustee is a company that has set up that umbrella trust. Yeah, because a simple. Let me go back a little bit. For any trust to exist, it must have guiding rules on how it is going to operate. Yeah. So there's what we call the trust rules. Yeah. So in the case of a simple trust, the company usually create those rules, general rules on how that simple trust is going to operate. So when you come in as Elisha to set up this trust, what you do is that you define a very few aspects to your specific trust. You'll be joining an umbrella that is already existing. So you define very few aspects of your trust that relate to you. So in this case, you'll be saying who is the beneficiary of the trust that you're setting it up. What is the purpose that you're setting it up? If the beneficiary is a minor, then who take care of that minor in the event you, as Elisha, as the person who has set it up, is not there. Yeah. So now the trustee who is managing that portfolio, because I'll get you 5,000, I'll get $1 million from another person, I'll get 10 million from another person, and put them in a pool and invest. Yeah. So now the trustee will be using that money to pay whichever disbursement that need to be paid. So the trustee is their work to ensure that every payment is well documented and supported. Now, on the other hand, the guardian comes in to act on behalf of a person who does not have the capacity to act.
So like a minor,
you may have someone with special need. Anyone who has no capacity to act. So the guardian is not there as a beneficiary. The guardian is just there to be a liaison person between the trustee, that is the company, and the minor, because the minor cannot come and say pay school fees. That's the distinction. I hope that one clarifies.
That is clear.
Yeah.
So how does a trust help avoid family conflicts or drawn out succession battles?
Yeah, so maybe before we go to that, I just remember you had asked the access on two front.
Yes.
Now, for the family trust, the access of the benefits to the specific beneficiary
Yes.
are mainly determined by the rules that you set up at the point of setup, and now the trustees are the one who action. And for a family trust or a living trust, the trustee is not necessarily a company.
Yes.
It can be individual trustee.
Yes.
So they are the ones who are going to execute those instructions based on what the founder wanted. So if the founder wanted a particular portfolio to be paying school fees for the children, grandchildren, or whoever, then the trustees are the one to continuously execute that according to the mandate that they have been given by the trust deed that guides operation of that specific family trust. Yeah, so I thought it is important to note that everything is determined by the rules that have been set by the founder.
Yes.
Yeah.
Okay. All right. So that's a very important clarification to make. I'm glad that you made that clarification.
Yeah.
There was the question on how it helps families avoid drawn out conflicts on succession.
Yeah. That's an important aspect because conflict is the one that now make the process longer. Yeah. So the moment there's conflict in a succession case, it makes the process much longer. Yeah. So just to go back, I said there are tools to do estate planning.
Yes.
And one of it was a will.
Yes.
Yeah. A will remaining as tool of estate planning, it has its own challenges that can be challenged, and there can be conflict, and it takes time to do to be sorted sometime.
Yes.
There are instances where the will has worked, where every family member or every beneficiary is in agreement, so they go through a court process, they are given the letters of administration, and they complete that process. So there are instances that happen. However, in majority of the cases, there are issues. Yeah. So a trust, how it avoids that is that it doesn't go through a probate or doesn't go through court process to be validated.
Yes.
So the moment the founder is not there, then the trust deed or the trust has rules on what is going to happen. The trustees are already there.
How is it activated? Suppose you have a living trust now, and or suppose I have a living trust and I pass away. How is it activated? How is my family going to be able to start engaging with the trustees? Is there a formal process, or how does it work?
Yeah, so in the event the founder is not there, now the people who, or the person or the entities that they appointed as the trustee, they are the ones who initiate the engagement almost immediately, because they are, you cannot appoint someone as a trustee and they are not aware.
Yes.
They must be aware that you have appointed them as a trustee. So they know that their mandate kicks in at a particular time based on the rules that have been highlighted in the trust deed.
Yes.
So there are instances where I will create my own trust today and say in my lifetime, I continue managing that trust. So I'll be the founder at the same time as a trustee. But in the event that I'm not there, I have said who become the new trustee. So the new trustee, whether individual or otherwise, they will kick in immediately to manage the estate as instructed in the trust deed. So there may need no family initiating that. The family may consult on what structure did the person leave in place. Now, if they find out that it is a trust, then it's upon who is a trustee and who now pick up the management of the trust assets. Yeah.
Okay. Okay. That is quite clear. What are some of the common mistakes people make when thinking about estate planning?
The common one is to make it complicated or think that is a very complicated thing to do. even though, as I said before, is we do estate planning unknowingly. So we shouldn't look at estate planning as a very complicated subject. You start from where you are. Yeah. So waiting until the common mistake is waiting until you have a lot, and you don't know when that a lot will come. Yeah. So that become a challenge because again, unfortunately, God did not give us the grace to know when we exit.
Yes.
So when you wait at the right time, you don't know when will be there. When will be that right time? Is it after 1 year, 2 years, 5 years, 10 years?
Yeah.
So making it look very complicated, that's the biggest undoing. So start where you are.
Yes.
So do you have insurance policy? Do you have just a few investment here and there? See how you can start something small.
Yes.
Then grow it as you go.
Yeah.
Yeah. The structure will become more comprehensive as a portfolio. The portfolio grow.
Yes.
Yeah.
Okay. There's something that I wanted to ask you. For the cash trust. You mentioned you can have things like your MMF or your bonds or other things which are not cash itself.
Yeah.
How are they assigned to the trust?
Yeah. So usually what happens is that the assets that you can put in a simple trust or in a cash trust, these are assets that have room to nominate beneficiary.
Yes.
Yeah.
Yes.
So what you'll be doing, you'll be replacing the specific beneficiary that you have nominated, that is the individual, to the trust fund that you have created.
Yes.
So this just ensures that in the event that you are not there, money doesn't go to an individual, but it goes to a trust that has on the back end the beneficiary and how they benefit.
Okay.
So just to be clear, there are some assets. Yes, they are a bit financial, but they don't have room to nominate a beneficiary.
Okay.
So for those kind of assets, then you cannot provide them in a simple trust.
Okay.
So this one is specifically for assets that have room to nominate a beneficiary.
Okay. Understood.
Yeah.
So as we close, how often should someone review or update the estate plan, and what kind of life events should trigger a review?
Now, you may not have a very specific, because individual, again, they are unique in their own ways. Families are unique in their own ways. So you'll not put in at 1 year, 2 years, 3 years, 5 years that one should review. But once you start, if you have started your estate plan, then what you need to do is that every time there is material change in your life, and material change means that you are single, now you are married.
Yes.
You need to have an update.
Yes.
You had 2 children, now you have 3. You need to make provision for that.
Okay.
Yeah. So you had provided for one beneficiary, now they are above the age of 25. You want to remove them from being beneficiary to the education because they have already done with school.
Yeah.
So it's a process that you continuously you are supposed to continuously update as there any material change in your life that affect those who you expect to benefit from your estate. So, and that's why by definition, estate planning is not an event. It's a process. So you continuously update. You have acquired assets, update. You have taken a new whole life insurance, update. So you continuously update as there are material changes in your life. That's my view. Yeah.
And I agree with that view.
Yeah.
So finally, what is your message to someone who has been putting off estate planning because they feel it's overwhelming or uncomfortable?
Yeah, so I know even in our African kind of a setup, sometimes we avoid having the conversation around what if I'm not there. So usually what I say is that whether you talk about it or not, it's going to happen to all of us. Yeah? It's inevitable. So then the other element is the people who feel that they don't have a lot to put in a nest egg plan. What I would say is that one, have this conversation. Two, start where you are. You don't have to wait until you have a lot to start. Start with the simplest of them all. Then you make steps as you go, because you wait until you have a lot. You don't know when that is going to happen, and you don't have a clear idea on how long you've been in this world. So to avoid a situation whereby other people will be making decisions for you, because when you're not there, other people make decisions, and the decision that they make may not be in the best interest of your beneficiary, and may not be the same decision that you would have made if you are there. So it's better to make those decisions. Otherwise, if you don't, someone else is going to make them, either your family or even the government, because if you don't create a plan, then it means the government will have to plan you. So it's better you make those simple steps as early as now. Don't make it complicated. Start where you are and progress as time goes.
Okay. Thank you so much, Nashon, for making the time to be with us here. I truly appreciate it. I know it has been beneficial to me. I hope it has been beneficial to those who are watching. We will call on you from time to time to draw on your expertise, but we just want to appreciate your time.
Thank you so much for having me. It's an honor to have this conversation, and we continue with this conversation as time goes, to ensure that each and every person is able to make proper plan, and they're not waiting for someone else to plan for them. Thank you.
So if you liked what you saw today, if this information resonated with you and you'd like to find out more, reach out to us. If you generally like the content that we are creating, please like, share, and subscribe, and hit the notification bell.